Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, I brought on a special guest, Toby Mathis. Toby's a 25-year tax attorney and founding partner at Anderson Advisors. Toby advances his clients' interest by combining expert tax advice with his personal experience investing in over 200 real estate projects in the U.S. His expertise reaches many others through his award-winning publications, including Tax-Wise Business Ownership and Infinity Investing, How the Rich Get Richer and How You Can Do the Same. Toby, welcome to the show.
Hey, thanks for having me.
So I think pretty much find that everyone is interested in investing these days, and especially when you start thinking about how infinity investing, getting richer. So I'm definitely looking forward to the topic. Can you start off by sharing a little bit of your background, including what led you to become a tax attorney?
Yeah, it's kind of a long and windy road, like a lot of people's stories, but I had a really good mentor when I was in high school and college. I didn't really intend to go to college. I went because I could kick a soccer ball. That's the only reason I went. I never even applied. I just happened to want to go play soccer. So I was like, cool. But I had a mentor who said, hey, come work with my business. And I did. And his son and I went to high school together. And while we were doing this, he was a liquidator. So we would sell anything to anybody, anywhere. You know, we were doing all sorts of auctions. We worked with Nordstrom's, Costco, Home Depot. We liquidated Pay and Pack, if you remember. But what we found is that the lawyers were horrible. And there was a transaction that we were doing in Mexico with Chinese fixtures that were actually with the Bush Tower Group, which was Bush Senior's a bunch of warehouses that hadn't been paid for as a result of the Pay and Pack bankruptcy, where them terminating and not paying. So we eventually were buying all these fixtures, which is light fixtures and things like that. And we asked for a larger firm in Seattle. I won't name the firm, but I'll make fun of them in my own head. But, you know, they charged $10,000 to do an analysis of the transaction, about a $10 million transaction or something along those lines. And they used up every nickel to write that opinion. And it was kind of like the way I explain it now is the opinion was you shouldn't speed, right? It's like speeding above 60 miles an hour is illegal. Instead of saying, well, what's the consequence if I go 65? Right. So we looked at it. There was really nothing there. There was no teeth in anything. And the dad looked at me and his son and said, you guys need to go to law school. These lawyers are going to just kill our business. They find every reason not to do something and they can never find a reason to do something. And that's when I went to law school. Never worked for a big firm. I shingle out right away. Worked with small business owners and investors since day one. That was in 1997. So I guess that's 26 years. And, I never looked back and had a single regret of it. I just really enjoyed it. I just never looked at the law as hey, I want to be Perry Mason. I looked at it and said, hey, you need to know these things if you're going to be a successful business owner and a successful investor. And along the way, I realized that the same kind of crappy advice we get from a lot of the legal profession, and no offense to my lawyer brethren out there, but let's be real, a lot of us have never run the business that our clients are in and don't understand the nuances, but we're still willing to charge a lot for our opinion on things that maybe we shouldn't be. You know, just because you know the law doesn't mean you know business. But I realized that CPAs weren't much better and EAs weren't much better. And accountants, again, would always tell you all the horrible things that would happen to you and never really draw out a path of here's how to do things. And there are some, but I just realized that in my experience, it was a disheartening experience. Like I remember sitting down with the first CPA, and I know this is a long answer, Mark, but you might identify with this, but some of your listeners might. I didn't have any money when I started my business. I had a 400 square foot studio, and I saved up to meet with the accountant. It was $300 for an hour. When I say I saved up, I used to joke, it's like I didn't have the funds to go and just go see a professional. I actually saved up. I didn't want to have debt. And so I was one of those guys that actually, it's going to be $300. So I'll start saving it up. I'll put a few dollars here. And then I got to go sit down with this guy and I was all excited because I thought He was going to give me some great knowledge, and he made me feel like an idiot for opening up my own business. He used big language. He talked over my head. And I was an attorney, so it wasn't like I was a dummy. But what I think he did is just, kind of how they pontificate, show you how smart they are. And I walked out of that, that hour-long meeting, $300 poorer and feeling about 2 inches tall. And I just made kind of a commitment to myself at that point. I would never do that to somebody else. Like, this is not difficult. Making money is not difficult. Anybody who's done it will tell you, yeah, that first million's tough. But after that, it gets a lot easier because you quit paying attention to the little stuff that is a distraction and you start focusing on what's important. Uber successful people tend to be kind of disruptors. They see something that we don't see. They fill a need that we didn't realize could be filled, and they do that. But at the end of the day, what it comes down to is taking a little bit of risk and believing in yourself, and you'll be successful. In investing, it's just math. It's just understanding the math and believing the math so that you don't do things that harm yourself because of your emotions. That's kind of my thumbnail version of how I got into this and how I think. And then as a result, I've been practicing in this area for 25 years plus. And I work with a lot of really great investors. My firm has over 500 people in it. It's CPAs, accountants, EAs, bookkeepers, you name it. But I learn from my clients. I watch them carefully. I look at the successful people, and it becomes really obvious what works. And just as equally, you could see what doesn't work because it repeats itself. And in our practice, because we do over 10,000 tax returns a year for investors, I can watch the trends. I can see, oh man, these guys are getting slaughtered. What are they doing? Hey, they're all doing kind of the same thing. Let's not do that.
Is that kind of how you got the idea for infinity investing, is what you saw from all these investors that you work with?
Yep. I don't have an original idea in my head. What I do is I observe and I write down after years. I think I wrote Infinity Investing a couple years ago, but it started about 6-7 years ago when just one of my clients was asking me questions and asked me to come address a group. It was like 2,000 people. Their regular speaker on financial planning wasn't able to make it. And I said, well, I'm not a financial planner. And the client's like, I've been working with you for 20 years. You're a better financial planner than my financial planner. And it's actually pretty obvious, Mark. The tax code tells us what to invest in. It's almost like if you're willing to listen to the universe and you realize where you're getting smacked, then you stop doing the things that get you smacked. And if you go over here and you get a reward, you start going over to where the rewards are. It's like we're kind of like lab mice. Just let ourselves realize that there's a lot of things that we get hit on. And in the tax code, it's pretty blatant. But all I did is I wrote a book called Infinity Investing. And I just realized that the people that really did well and did well over a longer period of time and made substantial wealth that's not going away, their time horizon was a lot longer than yours and mine. They were thinking in terms of generational wealth. They were thinking of 200 years down the future, 100 years, 300 years. It was never, hey, how am I going to have enough for retirement? They were thinking of, I want to build something up that creates wealth for future generations. And I'll be dang, but they were hitting it over and over and over and over again. And I'd watch these folks, and I had a great mentor, but he had a whole bunch of folks that were successful. And I looked like, my God, these guys are all doing the same thing. They're in different businesses, but they would transition their wealth to the exact same stuff. I mean, real estate's the obvious one. And from a tax standpoint is by far and away the best investment, just about. Like maybe you could argue oil and gas or something like that. But as far as just the tax benefits and the step up in basis when we pass 1031 exchanges that don't exist for any other assets, like you could literally grow a substantial amount of wealth in real estate. And if you resist the temptation of selling it off, and you could still sell as a 1031, but like if you resist the temptation of getting rid of your real estate, you could live off that real estate, borrow on that real estate, and never pay a nickel in tax on any of those funds. And then when you die, not only do your kids not have to pay tax, but then they get to redepreciate it again at its fair market value when you die. So they get to take another deduction. There is nothing out there like that, where you could actually buy, deduct because I bought it, trade it for something worth more, not pay tax, borrow against it, not have to pay tax on that. And then when I die, the people that I leave behind can actually do it again. that type of obvious stuff is what's in infinity investing.
What else in addition to real estate did you see any trends, whether it's asset classes or just habits or something that the wealthy were doing different?
Yeah, I could say that studies with the IRS, and I'm a data freak, so I love looking at their publications every year of who pays taxes, who doesn't, who gets audited, who loses audits, and all that fun stuff. But millionaires make the minority of their income from active income. By all accounts, when you look at the stats, it's less than 40% of their income comes from working. And I say active, things that they actually materially participate in. And that's a technical term. Material participation means basically 500 hours or more a year working in. So like I could have lots of businesses, but there might be only one business that I work in. And it's making the least amount of my money on an annual basis if I'm making $1 million or more. The vast majority is in the portfolio income realm and rents. In portfolio income, it's worth touching on this, and I'll explain the difference from a tax standpoint in a second, but it's just portfolio income is things like dividends. It's capital gains. In dividends, for those of you guys who don't know, qualified dividends on U.S. companies, they're taxed as long-term capital gains. So if you're a married couple and your taxable income is less than, I think it's $89,000 this year, you pay zero on that dividends. Like you could be getting money every year tax-free. And why people aren't doing it? Why are they chasing other investments, this, that, and the other, where they're getting hit with the tax stick every time they make a dollar? I don't understand. I look at it saying, hey, it's not what you make, it's what you keep. I could get $8 over here. I get $10 over here. If I make $10 and I only get to keep $5, that means I probably shouldn't do that if I get to keep 100% of the $7 or $8. And there's investments where you get to keep every dollar. And then there's investments where you only get to keep a partial. And the most obvious is you and I work, right? And if we make a dollar, you have withholding, you have federal income tax, you have state income tax, and you have this thing called Social Security, which never gets discussed unless they're saying, we're going to lose it. No, it's old age disability and survivors benefits. It's 12.4%, and Medicare, which is 2.9%. So it's 15.3%. And if you look at our gross receipts from our country, all the tax revenue that it makes, every now and again, employment taxes, Social Security, is more than income taxes to our treasury, but we never talk about it. Like they never talk about, hey, the biggest burden on all these people who supposedly don't pay, they always say, half the people don't pay income taxes. Well, they're still paying employment taxes. I worked at McDonald's. I was making $4.15 an hour, and I didn't get $4.15 an hour. I got about $3.50 an hour because every dollar I made, I had to pay the government and I had to pay employment taxes. And even though I made so little that I get a refund of my income taxes, they did not refund me my employment taxes. I had to pay every day. That's active income. And we do not charge Social Security taxes on dividends or rents or other types of portfolio income like interest or royalties, capital gains as a whole. We do not pay employment taxes on. So if you just remove the employment taxes, which is about half the money that we collect as a country, could you just imagine what happens? So that's what the rich do, is they avoid those employment taxes as best they can. And even if you're an active business, you could avoid them. Like people don't realize that even as hey, I have my own gig, I could cut my employment taxes by simply being, for example, an S Corp and taking a small salary, and I can cut my employment taxes by about 60, 70%. It's just knowing what the rules are.
I think you find most people want to get on that side you're talking about, that passive investment where portfolio income is generating and you can minimize the tax. But what are some of the ways that you've seen people get to that side so that a majority of their income is there? Because the typical one is you hear, okay, I'm going to have this active income from working that's going to feed the portfolio. But is there a way to accelerate that to get to the side where the portfolio income is producing a majority of your income?
Yeah, absolutely. So I systematically do it. So that's part of the whole infinity income idea, is that I look at 5 types of income, which is rents, royalties, dividends, interest, and short-term capital gains from the sale of options on your portfolio. Like I'm not an option buyer, I'm an option seller. So I sell covered calls in essence. I call it being a stock market landlord. So we treat our stock investing just like we do real estate. But you're looking at those 5 types of income sources, and you deliberately go out and acquire assets that produce them. I recommend people use a simple 70-30 rule. Live off of 70% of your take home, and 30% of your take home you assign to, you could even set up different bank accounts. Like, hey, when my paycheck comes in, I don't trust myself. I might see money in my account and go out and splurge. What you do is you take 10% and you put it aside for giving. And don't worry, guys, I was broker than a joke before. I'll tell you the workaround on that. But if you can, you put 10% aside for giving, 10% aside for paying down your debts, not paying your debts, but paying down your debts. In other words, extra above the minimums, and 10% for investing. And so I'm not one of those guys, like I understand Dave Ramsey's out there like, hey, pay all your debts down. I say pay your debts down and invest, but live off of less than you bring home. And then if you're one of those people that says, hey, Toby, I don't make enough to have less, then I'm like, okay, first off, we have to talk about priorities. There's generally a way to live below your means unless you're below, $2,500 a month or something like that. I get it. Then I would say, hey, you better get some side gigs, an extra job, because we're going to have to fund these buckets somehow. But if you are in that category where you're like, I just don't have enough money to give, some people tithe. I'm not a believer in just tithing. I'm like, you could give it to a number of resources, but let's say you can't, then give time. It's like when I was in college, I didn't have any money. So I gave time. I worked at Northwest Harvest, and you donate time to do things. You got to do it. Everybody I know that's been successful and all the really wealthy folks are givers, period. I just don't know anybody who doesn't give back. It's this whole reaping and sowing thing, or karma, however you want to articulate it. But I think it's really, really important because I don't see people breaking the rule. If you go out and you give, you tend to receive. And I think that's important. You're not doing it because you're going to receive. You do it because successful people, that's what they do. And it's also good for society. So you could take that 10% and dump it straight into your investing if you wanted to maximize it. The other side is debt, paying down your debt. Once your debts are gone, you could literally be putting 30% of your take-home pay into investing. And here's how I know it works. There's a guy, Steve Hogan, he works with Dave Ramsey. I think his name is Steve, but they did this big study of over 10,000 millionaires. And the top 3 categories, I don't know if you know this, Mark, I'll put you on the spot. Do you know who the top 3 professions that were millionaires were out of that group?
No, I don't.
It's going to blow your mind. Accountants, engineers, and teachers. It wasn't real estate agents. It wasn't banking executives or whatever else. When you look at it across the whole, it was some pretty, like, engineers make some pretty good money. Accountants do okay. Teachers, come on, they're probably averaging about 70 grand a year, right? But they were making up the biggest categories. Why is that? I look at it and I'm like, I think I know. Engineers are methodical and they follow numbers. Accountants are methodical and they follow numbers. And teachers love what they're doing. And they get into a habit of having money taken out of their paycheck and put aside, usually through a retirement plan or something. And if they just do that long enough, they magically become a millionaire. And that's all I'm saying with the 70-30 is if you could have it to where you have a different bank account every time a check comes in, you auto pay 10% over into account number 1, 10% into account number 2, 10% into account number 3, and then you live off of what's left in account number 4. If that's all you did, you do that for 20, 30 years, you're going to be flabbergasted if you put that money aside. And if all you did was put it into an index fund like SPY, and all you did is just religiously, consistently paid that in there, and it's 20 years later, you have about a 92% chance of beating all the money managers. You're going to do better than everybody else, and you're going to have a pile of cash sitting there. Because the S&P since 1922 or whatever they have is averaging over 10% return, which means your money's doubling every 7 years. So you're putting money in there. It could be $200-300 a month. It could be $100 a month. You just consistently do it. It's going to be a pile of money by the time you retire.
You bring up an interesting point about the S&P 500. One of the things from your book that I found really interesting, and I guess you can say mind-blowing, was you mentioned dividends before, and you talk about dividend kings. I think, is it Dividend King? Is it a company that's raised its dividend for, is it 50 years straight?
50 years or more. Yep, there's about 25 of them.
Yeah, and I guess that's a big show of strength from a company that, in all kinds of business environments, they are strong enough to not even cut, not keep it the same, to actually raise it every year. But what your study was, if someone took, and I think it was $100,000 and put it into, and I think this was from 1991, if they put it into the S&P 500, which everyone loves, everyone can identify with and wants to beat, and this, you put 100,000 into the S&P 500, 1991, put 100,000 into the list of dividend kings, those 25, and what you'd come out with at the end. I think the S&P 500, that 100,000 would be worth 1.3 million, but the dividend king portfolio was worth 3.2 million. So that's kind of a testament to how powerful some of these dividend payers are.
It's the magic of compounding, because even when you look at the S&P has a dividend yield of it. I think it's right around 2.5%-ish. Don't quote me on that, but it's somewhere just above 2. The Kings, I don't know where their total yield is, but sometimes it's great. But the thing is that not only is the stock growing, but the dividend's growing. So if it was 10 cents in year 1 and it's 11 cents in year 2, 12 cents in year 3, 13 cents in year 4, and you go fast forward 30 years, you're making back in the dividends almost on an annual basis about what you paid for the stock. I think Warren Buffett's proved this point because he bought Coca-Cola in the 80s. And just go look at the dividend that was being paid out in the 80s and look at it now. And Coca-Cola is a dividend king. I think it's been raising its dividend for 56 years or thereabouts. Procter & Gamble, 3M, Federal Realty Trust, if you like real estate. But there's like a lot of different companies on that list that you're kind of like, you just know the names. But they're not sexy. You say Tesla and people are like, oh, I could go up 1,000%. I don't want 1,000%. What do I want? Consistent growth for 200 years. I need to have a company that I know has been there, done that, it's got the t-shirt. And I'm not just going to do that. I'm going to make money in another way. I'm going to write calls out of the money, basically short-term calls if I want to make a little extra return. And then that 3.2 becomes 4.55 million.
Can you walk through an example of doing that? So let's say someone buys 100 shares of Coke. Can you walk through an example of how you can use that to write calls to generate more income on top of the income that Coke is providing?
Yeah, let's say that you do Coca-Cola, which is, I think it's around $60 or something like that, right? So let's say that you buy 100 shares and your purchase price was $60. You might write a $62.50 call for next month, and maybe you get 50 cents, so you're getting $50, right? Minus might be a commission, maybe $2 or whatever it is, depending on your brokerage house. Sometimes they're free, sometimes they're a few bucks. Let's just say it's $5. We'll estimate high. So you got an extra $45. That's all. Now, if Coca-Cola jumps up and goes to like 65, you're going to get not only the $62.50 for your share, but you're also going to get to keep the money that you got. Let's say it was 50 cents. So you basically got 63 cents. Worst case scenario. There's a way to roll out of it and keep extending it. But in its simplest sense, you get to keep that 50 cents no matter what. So let's say that Coca-Cola doesn't go above $62.50, but it stays around $60 to $61. Then your option expires. You keep the $50, and then you sell it again the next month.
And you still have the shares of Coca-Cola at that point.
You still have the shares. Whatever it might be. And I have clients that do really, really well with covered calls. It's kind of boring. And by the way, there's a really good guy, I think it's Kevin Simpson, who does this. And he has I think it's a $7.5 billion fund. It's an ETF called Devo. Not to tell anybody to go do it, but really neat guy. But that's the philosophy behind it. And I've actually spoken to him, and it's like, there's people that do this that are institutional. You're never going to hear about it because it's not exciting and it doesn't have the big losses that half the time people are watching Kramer just so that they could laugh at him when he's wrong. They have the inverse Kramer ETF. They just love doing that. I'm like, well, they're watching him. He's probably happy saying, hey, I got a really big audience.
He doesn't care. He's happy with the audience.
Yep. And I'm looking at going, well, yeah, you know what? Make money in private. Do whatever you're doing in public, but make your money in private. Keep your family stuff with your family. Make your wealth. Do it in secret. Do it in the closet. Do it in the dark. Make your money. Don't let anybody know. Teach your family and be patient, and you'll make it. And we just hit the stock market. Real estate's the same thing, except real estate, you get an added bonus. So if I have $1,000 that I invest in stock, let's say I bought $6,000 worth of Coca-Cola, and I put $6,000 down on a house. I can't depreciate the $6,000 I bought in Coca-Cola. If I buy a house, I get depreciation. I could actually, let's say I put $6,000 down on a house and I finance $100,000. So I have a property worth $106,000. I can't depreciate the land, but I can depreciate its improvements. Let's say I get $70 of or $70,000 of depreciation that I'm going to take over some time horizon. We can make it short or we can make it long, depending on whether you know what a cost seg is. But the point is that I could put $6,000 down and I could actually get greater than a $6,000 loss every year if I wanted to. I don't know of another investment like that, where I could literally invest in something and the IRS says, you know what, because you invested in that, you're entitled to a nice big fat deduction. But I didn't lose any money. I actually made money. Yeah, I know. But we're going to pretend that you lost money. That's what depreciation is. They got really mad at our last president, Trump, because he was able to carry back a bunch of losses on one of his real estate projects. I think it was Trump Tower. And he took back and got all these monies back that he had paid in taxes because they let us carry back real estate losses. He's a real estate professional, so he can write off against all of his other types of income. Well, they did that during COVID too. They allowed us to carry back. But most of the time, you're just looking at it saying, hey, I made an extra $20,000 in my real estate and it's tax-free. I'll take that action all day long, every day, 24/7.
Is there a way to take advantage of some of those tax benefits that you're talking about with real estate, like depreciation, through like listed stocks or stocks? Or is it just, no, you have to go out and actually take title or purchase the property yourself?
Yep, you actually have to do it. I mean, I think that there might be like syndications. You could go out and do it. You can have the flow through depreciation. We have what's passive activity loss rules, and then it's always going to be dependent on the tax structure. But if you go out into partnerships, you probably could. If you go do syndications, you could. But in the publicly traded realm, when you're doing REITs and stuff, you're not. You just have your basis in the stock that you purchased.
And then whatever income flows down.
The good news with the REIT is basically a real estate trust that is a company that's required to follow some guidelines to operate. And one of those guidelines is to pay out 90% of its income every year to the shareholders. So if you want to be in real estate without actually buying real estate yourself, that's a good way to get started, because I could buy, Federal Realty Trust or any of these public storage. There's a few that you could do pretty. I'm trying to think of how expensive they are, but Federal Realty Trust, I think it's maybe $150 a share. Like, you go out there and buy some of these things and be exposed just with hundreds of dollars and not have to go out there and deal with all the complexities of actually owning the real estate. The second tier is, as you build up assets, you might look at some private placements and doing syndications. But I would really say make sure that you're an accredited investor at that point. And if you're asking what an accredited investor is, you're probably not, right? The accredited investor, you got over $1 million of assets without including your house. Or you're making, if you're married, I think it's $300,000 a year for 3 years. So if that's not you, then I probably would avoid the syndications to start. I would just do REITs. And I would also be focusing on smaller real estate projects like cash flow real estate in your backyard, or pick places like you're in New Jersey. Probably not going to find anything that's going to cash flow there, but maybe you look down the coast and go to North Carolina or some other states. Kansas City, Missouri is a good one. We do a lot in Winston-Salem, North Carolina, so I can speak to that one. But you could buy houses for less than $100,000 that are little cash flow machines making maybe $700-800 a month. You do some of that. It's not horrifically expensive. Sometimes you're shocked at how inexpensive it is, and you just realize people need a place to live. We are probably 5 to 7 million units shy, underbuilt in the United States. Like, there's a big demand. People keep saying real estate's going to crash, and I keep saying I just might go down a little bit, maybe on the coast, but I'm telling you, doing this a long time, rents aren't going down. They may be slowing down, but real estate went up 38% in the last 3 years. And they're saying, oh, it's going to crash. It might go back down 10%, but that just means that we're 35% over where we were 3 years ago. Like, again, I'd still take that action.
Yeah, especially if it's cash flowing, and then you don't have to worry too much about whether the asset value has a temporary dip or not.
Mark, I was talking to a gal, Nicole DeBrasio. She was second place on The Apprentice in season 6. So she's like a pretty sharp cookie. And I said, do you ever buy on comp? And she goes, do I have stupid written across my forehead? I said, no, I don't see it written across your forehead. And she goes, no, investors buy on cash flow. They do not buy on comp. And I was like, I was just asking.
Yeah.
Don't get mad. investors look at and say, how much return on my money? They're not really worried what the value of the property is because they're never going to sell it. Or if they're going to sell it, they're just going to trade it for something else in a 1031 exchange. So the way I explain it is, could you imagine having a ticker signal over your house and it says what its value is every day? So you come home and you're feeling good and it has it's in the red. Your house lost $10,000 today. And you're like, what? No, if you're not going to sell your house, you don't care. Like, I'm sorry, I don't care what my house is worth. You could tell me it's worth $1 million. You could tell me it's worth $500,000. I'm not moving. I always look at people that watch their stocks like hawks and in their real estate. And I'm like, quit doing that. Maybe once a year you want to do a value, but knock that off. You're buying it because it's paying you. And maybe if you could trade it for something else that pays you more, you do it. But otherwise, quit worrying about it.
Yeah, I often wonder how people what actions they would take if they saw a daily breakdown of their real estate and its fluctuations. Because I think a lot of people don't see it and they don't assume that it does fluctuate, but it does. But yet they're hit with the fire hose of the Dow went up this or the S&P did this and people want to do this or do that. And it's like similar things where the asset values fluctuate, yet people take two widely different approaches to how they react to that.
Isn't it wild? Warren Buffett said, I think it's just what he said. One of the best things you can do as an investor is take that right hand and stuff it underneath your right butt cheek and take your left hand and stuff it underneath your left butt cheek and sit on your hands. The stuff on the TV is all about movement.
Yeah. I think Fidelity did a study. What they came up with is that the two types of investors that did the best, I think it was in their 401ks, were ones that had either died or lost their password to their account. So there's something to that.
I actually did a video once and I said a life hack. Set your account on auto pay and auto invest, lose your password, find it 20 years later. Yeah, we're our own worst enemy. Absolutely. If we could just stop the emotions, making money is mathematics, and mathematics doesn't really care about our feelings or, if it's up or down. It's just looking at it saying, here's what the average is over a long horizon. Make that long horizon and you'll get the same result. We're just a little impatient.
It's a dangerous game to try and time that stuff. I come across so many people that they'll be actively contributing to their 401k. They don't look at it. And then they do after a year or 2 years. And they're like, whoa, can't believe it really has grown this fast. And it really is a testament to compounding, to some of the dividend reinvestments and, having an automated machine where this thing, you're pumping money into it, you're not even realizing it. And boom, you see the power of those and how quickly it can grow.
Compounding is where it's at, but compounding over a long time horizon.
Yeah.
Not to circle this back, but that was the one thing that I kept noticing on the folks that were most successful is they didn't spend the money when they made it. They had a long-term objective. And, I'm not one of those guys to say, set a goal is the only way to achieve success. No, but they happen to want to not have to work, so they were like, hey, this is my long game. And I don't want my kids to have something where they just sell it and buy a Lamborghini. I want to have, an estate that continues to operate when I'm gone. So it needs to be on autoplay. I need to set it up to where it doesn't require me. So if I want to go to Tahiti, I can. If I want to go on that cruise ship for $30,000 a year where it goes to every port or whatever, spend a year at sea, I could do that. Once you do that, your investing gets pretty narrow. Hey, I got to make sure that it operates without me. Okay, there's very few things that you could do that'll keep doing that. And the math is the math. It works. It always does. There might be ups and downs, but over a long enough time horizon, they work themselves out. It's just no different than real estate and vacancy rates and repair rates. And when you start looking at these things, on one property, you have a vacancy, you have a 100% vacancy rate, right? You get 100 properties and it starts to work itself out. If you give things a long enough time and you look and you buy the right type of asset, I mean, again, you could just do a fund, make life easy on yourself in the real estate or in the stock market. And then in real estate, maybe get in the habit of buying syndications or REITs or do a few of your own. You'd have a few houses here and there. You realize that those numbers, those averages work. And it's just giving them time to pay you.
Yeah. Well, we're just about out of time today. Toby, I want to thank you for being a guest on the show. Ton of takeaways. You gave some great tips. We'll link to both your books in the show notes. How best can someone get in contact with you or learn more about the work you do at Anderson Advisors?
Yeah, I'll make it really easy. Just Google my name and look for my YouTube channel. Absolutely free. And you'll realize It's all about reaping and sowing. So there's over 500 free videos. We do free Q&A for tax every other week, something called Tax Tuesday. Easy peasy to find me, and you're welcome to come in there and use all that information. I don't ask for a dang thing in return, except that you go out there and be successful and do something good for society.
Great. We'll link to that, to your show or to your channel in the show notes as well. Thanks again, Toby, and thank you everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen to and leave us a review on the show.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.